Hello, everyone. This is Landon Jones, founder of Revisor. I'm here with Ethan Dunbar, our Chief Investment Officer, and Nick Cargill, our investment analyst. And we're here to talk today to give you a weekly market update. And where should we start, boys? Ethan, your end, or Nick on yours? Who wants to begin?
I can kick it off and do the market update, and then
All right,
go on to Nick's portfolio stuff.
let's do it.
All right, let's do it. So the economy first. The economy first. Last week was interesting. Last week, in particular, Powell's press conference was surprisingly dovish, and a lot of that I think is coming from the different components of the Fed and all of the feedback they're getting from their districts, and a lot of the sentiment that seems to be coming in is negative. Negative sentiment from the economy, basically leading to this expectation that the economy is suffering more than maybe is being indicated at the moment. There's more downbeat news than maybe expected, and that kind of led the Fed to, especially Powell, in both his comments and then in the question and answer section afterwards, to be a bit more dovish. The other thing that's been interesting in the economy, the Fed pays attention. They're very interested in core PCE, and that number they're very clear they want to get to a 2% target, and they're starting to get closer and closer. Now, some of the numbers, like your traditional CPI metric, are still a bit higher and a bit elevated, but they certainly have been coming down. Inflation has been coming down, and actually, if we look at the 6-month annualized change in core PCE over starting from this month, from this most recent release, we're actually at 2%. The previous month it was at 2.5%. So we've had, generally speaking, just inflation has been coming down, and that seemed to kind of release Chair Powell to talk more optimistically about their job in terms of getting inflation under control being closer to being done. Whether that's true or not, we'll see, but it certainly allowed him to talk more openly and more liberally about rate cuts in 2024, and that certainly changed the market quite a bit over the last week. Interest rates in particular, looking mainly in this case, talking about Treasury rates, Treasury yields, and the volatility was there. Absolutely, volatility was there. That continues to be high, and I think until we get more certainty from the Fed on exactly what's gonna be the path forward, expect that volatility to be high. But we've had really Treasury yields across the board, especially the longer dated, the more duration risky sections of the Treasury market, yields have just fallen drastically over the past month. Just for example, to highlight a couple, the 10-year yield is down about 55 basis points. The 20-year yield almost 60 basis points lower than it was a month ago, and we see that when we get into in a few moments here with Nick looking at the bond portfolios. The bond portfolios have been big beneficiaries of that lowering in interest rate environment, lowering in the yields falling, bond prices going up, yields falling. We certainly could be in for more of a consolidation period. Some of this could be overblown, just like in equity markets. You can get you can overbuy, you can oversell. We could have a little bit of euphoria in that market, especially with the dovish tone from Chair Powell last week. But I do think that overall, the trend seems to be trending towards duration risky assets doing well. And in 2024, they've certainly done well the last month. It's been one of the best months in recent years. And actually, if you stretch that back, it's been one of the best months, best periods of time in many years. So I think that will continue to be the trend in 2024. We'll start to see bonds recover. In fact, we were looking at this yesterday as a group. Bonds still are far from they're far off their bond indices. They are far off their previous highs. They have a long way to go, and I think even though we've had quite a bit of run up in the last month, I think that trend is still, we're just at the beginning of that trend. So we'll continue to watch that though. On the equity side of things, equity's interesting. We've talked about the relationship between interest rates, yields, levels of yields, and equity market valuations. I think we've talked about that enough the last couple of weeks. But wanted to focus a little bit more on what happens around these rate cutting cycles, what happens pre-rate cuts, what happens during a pause. And it's interesting, following initial rate cuts, whenever those do happen, sometime likely in 2024, U.S. equities are typically not the main beneficiary. They are typically the beneficiary during a period of time where we are in a pause. So we're at right now, the FOMC, we're definitely in a pause. We haven't had any interest rate hikes in a while. We're on pause. We're not hiking rates, lowering rates right now, and that's very common for the U.S. equity markets in particular. We're speaking specifically on equity only here. Very common for U.S. equities to be big beneficiaries during that period of time. Once that initial rate cut comes into play, though, especially in the next 8 to 12 weeks after that type of a change, emerging markets actually are very commonly one of the best performers in those periods, along with developed markets. A lot of that, I think of it kind of like a risk on, risk off situation. If you're looking at just equities, U.S. equities in particular, are generally considered oftentimes to be safer than the rest of the world, especially if you compare that to emerging markets. If we're going into a period where yields in the U.S. are going to be cut, where there's this general risk on sentiment, it could lead to people willing to take some more risk in stocks like in emerging market countries like we're talking about. The other thing that's interesting here is just general cheapness of markets, equity markets outside of the U.S. If you focus on if we just look at the S&P 500 as our example for the U.S. market, it's at a price to earnings ratio of about 23 right now, whereas emerging markets and developed market price to earnings ratios are closer to 15. So much cheaper, and that could be a very, very positive thing for developed and emerging market equities going forward if we go into a period where the U.S. is starting to cut interest rates in 2024. So definitely something to continue paying attention to, and could be something leading us towards emerging markets and developed markets actually outperforming the U.S. market for a period of time. So that is my story for the week.
I love it, man. That's all extremely interesting stuff. What would be just a real high level overview? What's some just with that last example of PE ratios, just looking at emerging markets versus let's say domestic equities. What would be a potential adjustment? What would be a potential play there? An attack from a tactical perspective. What might one like us do within our portfolio allocations to potentially take advantage of things of this nature?
Yeah, I look at it as a two-parter. Number one, so at the moment, most of our portfolios are 70% US, 30% international. Most of the portfolios are. A little bit of an overweight to US versus just the global market cap. If you were to globally market cap the world from start to finish, you would get about 60% US, 40% international. So we're right now about 70% US, 30% international. So we're a little bit overweight US in a period of time where we felt there could be a relative outperformance in international. That is something where you could start to see a big benefit to rebalance away from that overweight that we have currently towards a more neutral, maybe more like 60% US, 40% international, or maybe even lower, maybe even underweighting US versus what would be your typical global market cap weighted index of 60% US, 40% international. So that's kind of number one, just playing with the allocation for the portfolios with US versus international and starting to underweight US versus what we have right now. That's one adjustment. The other adjustment is within the international exposure. We typically have an overweight to international emerging versus developed. Right now we're overweight 60-40. So instead of having a split between emerging and developed, we start to overweight emerging markets versus developed. We've already been doing that to a degree, and that could become more extreme within that international exposure as well. So those are the two components that are likely to be adjusted in a period where we think international, both emerging and developed, could do well.
Got it. Awesome. I love it. Well, I guess Ethan, if that's all you've got, we can let Mr. Cargill take the stage. Tell us what he's got on his plate.
All right, let's get into it. All right. Thanks, Landon. Yeah, and that was great info Ethan brought as usual. Big theme we're going to see this week is going to be a broadening out of the rally. Earlier in this year, we saw a lot of, the top seven. We always talk about the top seven. You always see them talk about it on the news. We're starting to see this broaden out and starting to see more appreciation across the board throughout different types of equities and bonds. So going to be on the lookout for that this week. So with that being said, we'll start out with low volatility. Great week for small cap. Last week was a crazy week for small cap. I'm not sure if you guys saw it, but I think on Wednesday, might have been Wednesday, but one of the days, I think the Russell was up 4% in the day, which
Yeah, it was crazy.
crazy to see. So, close to 5% for small cap in the low volatility strategy last week. Pretty sweet for the week, and good return for the year too as well, up 23% year to date. Good week for mid cap also, and a good week for bonds as well. 1.88% for fixed income during a week, I would say is pretty awesome. 7% year to date, great return there. And we also saw a pretty good return for international. And that kind of ties into what Ethan was talking about. We may not have seen the rally that he's suggesting might come when we start seeing rate cuts, but possibly some of this is a little bit of anticipation of something like that. Good return for the year. Low volatility, large cap. We hold a lot of those top seven or in this strategy, and it's done well this year. So this week we had a little bit more of a broadening out, saw a little bit better performance in the broad market just this week. But year to date, really great performance of 53% in that sleeve overall this year. So a little bit of sacrifice this week, but really, really great year to date return there. Now we get into the dividend aristocrat, and this kind of ties into that broadening out here. So in the past, we talk about it. Value's been the laggard, and growth has been the real, really appreciated position. So this week, dividend aristocrat, large cap, up 2.74%. Great return for the week. Not as crazy of performance there year to date, just with that value exposure this year. We're expecting this to perform well going into the coming year and cycle. Just value in general, that exposure. Here again, we see international did great last week, 2.4%. Great for the year as well, year to date, close to 15%. Same fixed income sleeve, so nothing new to report there. But again, great week for fixed income. And actively passive, more value oriented right now. That's kind of our view. So with this being a bit more of a strategic allocation where we shift things around, with that value performing great this week, up 3.13%, and fixed income, same portfolio, nothing new there. Another pretty solid performer there with up 15.34% for the year to date figure. Finally, that brings us to the defensive sleeve. Great week, small cap again, tying into that narrative. Great week for mid cap as well. International also had a great week. This one here, this week, we had a little bit of underperformance, down week for healthcare. Defensive, seeking out low beta stocks. Obviously, we've got a decent amount of healthcare in there, dragging the performance down. We'll be watching this one in the coming year. With that exposure, should be a pretty solid performer. The interesting thing about fixed income, or I guess not interesting thing, if you want to contrast it to last week or compare it to last week, um, Ethan showed you earlier, the yields were lower pretty evenly across the board there. So we saw more consistent with what you might expect for short-term bonds versus intermediate and long-term. Long term's up higher, intermediate's up higher, and short term's up the least. So we're back to normal there, which is, I guess you could kind of say a good thing, but we're back in the normal realm of things.
Yep. Always good to be normal, Nick.
Yep.
Sometimes it's good to be normal.
Yeah, sometimes we abnormal, but
That's right.
When our performance is great, I love being abnormally great on the performance side. That is very true.
yeah.
That's a great time to be not normal.
Yes,
Yeah.
it is. Yes, it is.
Absolutely. All right. Well, if that does it for the equity and fixed income, the regular portion of our show here, we'll move into something a little bit different.
This is what I think it is. I've been excited to look at this. This is awesome. Are we going to get into the hard assets watches and whatnot?
Yeah, we were excited. Both Nick and I have like a sentimental interest in these type of markets. Watches we're talking about this week. It's been
Yeah.
one of my parents' friends. He's kind of like a second father to me, or grandpa to me. Arun is his name, and he let me try on his Rolex when I was like 10 years old. And I just love watches ever since.
That's great, man. This is I've had a little intro to this prior to the show, so this to me very, very interesting stuff. So I hope the rest of the audience loves it.
Talk about making a lot of money now. Now we can get to talk about spending it. So that'll be fun. Possibly making money, but mostly spending. So yeah, some neat data we found. Yeah, let's get into it. Some neat data we found here. There's a lot of services out there now with hard assets, just being able to track them and everything. A lot more stuff out there, a lot more data for us people to look at. So here we have some charts of the overall watch market brand or watch market index, and then some specific brands. Some things to note about this. This is the pre-owned market, so this is all secondary, which would kind of create this type of action, I guess, because if you're looking at a new item, it only moves with the price that the company sells it for. But we'll get into that later because that's not necessarily true. But overall, over the past 3 years, you can see we've got some positive performance here in the overall watch market, up 9.3%. And that's totally over the past 3 years. That's the total return. But you see this huge spike here from COVID where watch demand just went through the roof for one reason or another. Just any sort of luxury good, you just could not get your hands on it, drove prices through the roof. So the overall market index, maybe it'll help to get into how they construct this index. This is a service they call watchcharts.com. They track the secondary watch market. The overall index is constructed of 60 watches that are manufactured by the top 10 luxury brands. It's a list that's been curated by one of their experts to kind of be a good indication of what the overall pre-owned watch market does for luxury watches, that is. So it includes Rolex, Omega, some higher end brands, Patek Philippe, the ones when you get a little bit more into the whole watch space that you find out about. Um, and so that's how that one's constructed. The brand indices here are constructed by, they take the top 30 models and track their performance over this time period. So for Rolex, we have the top 30 models that they select to track. Omega, same thing. Casio, we included Casio here. That's an interesting one. Um, and Tag Heuer as well, just to get some different ends of the spectrum here. Here we have the 5 year. They don't have data that goes back all 5 years for the overall index or some of the other brands. So here we have Rolex, Omega, and Casio. You can see here pretty great return over 5 years. If you look at it, total return up 41.5% for Rolex watches, which is crazy to think about. Just a hard asset like that returning a performance like that.
That's
Crazy to think.
huge, man. That's
Yeah.
huge.
So here we'll get
We
into the
do tend to
more.
see that. Yeah, Nick, don't we tend to see that? And I think we might even have a slide on this later. But the higher end, the more scarcity you have in the watches, the rarer they are, the harder they are to get. The performance tends to be better. Just like anything where there's scarcity around the item, whatever it may be.
Yeah, definitely. And I think now is probably a good time to talk about it. Probably should have spoken about it earlier, but I think, like Ethan was saying, a lot of what's driving these prices here, we see Omega, which is a luxury brand, but a little bit more attainable for the middle class and everything like that. We don't see that same kind of jump here that we do with Rolex and the overall watch market. Um, and a lot of what's causing that is you can't walk into a store and buy a Rolex. You can't walk into the store and buy, a lot of these higher horology brands that we'll talk about later. Just you know, looking at the overall market, you can't walk in and buy one. You can walk in with $30,000, throw it on the table, and they'll turn you out of the store, which is crazy to me. But that's what drives this crazy performance. These pre-owned watches that are in this index, I was looking at the Rolex index. I think more than half of them are new models. So the retail price on these, let's see, like a Daytona, like a steel Daytona starts, the retail price is $15,000. If you're able to buy one and walk out of the store with it, it's worth like $30,000 to $34,000 on the secondary market. And that's where we get all this crazy price action is, people buying and selling these pre-owned watches. And since you can't get your hands on them, market demand, not enough supply, these things, they move a lot and create some interesting charts and figures for us to look at.
Yes, indeed. It is. It's pretty. It is really, from my perspective as an advisor, always looking for ways to essentially reduce volatility and increase returns simultaneously. That's really what I really want. Is I want that 10% rate of return portfolio that doesn't ever go down in value, is insured against risk and all those things, right? Which it's not out there. That's a unicorn, a unicorn investment, right? But this, how would you tie this in to the average person's portfolio? In other words, let's say, let's use not the 100 million or $200 million net worth investor, but even somebody that's, let's say, they've got a $5 million liquid portfolio, and they want to diversify. They want to hold some alternative type of assets. Um, Essentially, we could provide data, provide this kind of insight, and whether they're interested in watches or collectible automobiles or whatever the case may be. It's just a way to get into something different, whether obviously it's not liquid like traded, marketable securities. So you've got some illiquidity issues. But how would you, in general, just kind of pose this as a part of a portfolio, what would it typically do? Reduce volatility a little bit, maybe decrease returns a little bit on top of that decreased volatility, or what would be the general outcome of adding watches? I know we're talking about watches today, but whether it be watches, collectible automobiles, I know there's some difference in the return streams, but what would be the general theme and advantage of pulling some assets like this into a portfolio?
Yeah, and Ethan and I talked about this yesterday, so I think I've spoken a lot. I'll let Ethan take this one.
Yeah, I feel like these type of hard assets or collectible assets, they fit kind of. We wouldn't expect them to have the type of returns like equity markets. The but also not like bond markets either. They're more stable in my opinion. Very very much fit in the middle between equity and bond markets. I would expect long term to have greater rates of return for than bonds, but not as high as equity, and almost no correlation, especially in the higher end brands versus both equity and bond markets. So Nick pointed out earlier to me that there is actually a lot of correlation you see correlation in the price movements of your lower end brands like a tag or an Omega that you can go to a store and buy. They fluctuate with the economy. They fluctuate with in much higher correlation to the stock and bond market. But those items, whether it be like we're talking about a Rolex or a Patek Philippe or some of these very rare watch brands, or you go into like something like a collectible automobile, a Porsche or a Ferrari from 30 years ago that there's no more of these available. The correlation to all other assets is basically zero. So it's a really, you can have, I think there's opportunities in these markets if you know what you're doing to add a lot of value looking for the right watch, the right car, the right whatever. And especially if you have good relationships with like a dealer, for example, like Nick was talking about, if you get allocated a watch that you pay retail for at $15,000 and it's immediately worth $30,000, there's benefit there, right? But even more so, if you're able to get those allocations and you know what you're looking for in those markets, you can have really solid returns. But again, all of those are very non-correlated to the rest of the market. So when everything else is going all over the place, very likely that your collectible item, whether it be a watch or car or whatever, has almost no correlation with your traditional assets in a portfolio, especially stocks and bonds.
Absolutely.
That makes complete sense. I love it. Because really, what I've seen over the course of 22 years or whatever as a financial advisor, everybody's, a lot of times they're looking for the same thing, whatever's hot. Managed futures like mutual funds were really, really hot back, in the right after the 08, 09 debacle. So, this doesn't get brought up a lot, in my opinion, or the average financial advisor doesn't bring these options up a lot of times, and neither do, the client base. But in all reality, if you're objective with it, I mean, you can obviously run into problems, right? Somebody says they want, automobiles is the thing they want to diversify their portfolio with. Well, now you got to find a place to store those automobiles, right? You got this physical thing. Watches, obviously, you could probably have a fireproof safe and maybe, hold that in custody yourself right in your basement or whatever. But at the end of the day, you look at the return streams and the correlations, and it to me almost becomes a no-brainer. Whether you're replacing some of the bond holdings, or whether you're just trying to find some additional non-correlated return streams to throw into the portfolio. Um, this seems like a very, very prudent thing to at least consider. And again, whether it's watches, I can't wait to see stuff like we talked about before, automobiles, but also trading cards, baseball, basketball cards, and all of these different areas that a lot of people don't necessarily think of watches or collectible automobiles or baseball and basketball cards as a real investment. But define real investment. Let's look at the returns. what do the return streams look like, and how are we getting rewarded for as an investor, especially when we mix in that return stream with the rest of the portfolio. And sure looks very intriguing to me.
Yeah, anything that has scarcity around it, baseball cards, you know, cars, watches, whatever it may be, and there tends to be a lack of correlation with the rest of the market. It moves on its own. And like we're talking about here, a lot of these are the high end items like Rolex, Patek Philippe, a Ferrari, a Porsche, or something like that that is collectible. But it's not that you can't find instances where there are some lower, less, because you do have to deal with some, you have to lock up that money for a while, right? If you're going to buy a watch or a car or whatever, you have to deal with some liquidity issues. You have to be able to accept that. So you can't just go and sell your watch right away. You can sell it pretty quickly nowadays. There's a lot of online auctions sites. Same thing with cars, but you can't go in your Schwab account or your whatever your Fidelity account and liquidate that share of that watch or spend part of it. Right? You have to sell the whole thing. You've got, like you mentioned, Landon. You've got storage costs, insurance costs, all kinds of maintenance costs on some of these items as well. But like Nick has an interesting. Nick and I did a purchase of a watch recently for fun that he waited in line for me in Florida at a Swatch store, and it was just an interest. It's kind of a cool story. Y'all let Nick tell it, but it again goes along with the scarcity story. But anytime you can find scarcity, it's an interesting market and could be considered as part of a portfolio if someone with at least a portion of it.
Yeah, yeah, yeah. That's a crazy story. Basically, the story is Omega is owned by the Swatch Group. After the quartz crisis in the 70s, mechanical movements are going out because they're too expensive to make and no one's buying them anymore because you can get a quartz watch that does the same thing for less. So the Swiss watch industry, aside from the really high end brands that kept their demand, like Omega, they were bought by the Swatch Group and kept alive through that. So they're like a more premium option within the Swatch Group. Swatch Group, like GM owns Cadillac, and then they have Chevrolet and all that sort of stuff. So Swatch is part of the same family as Omega, and Omega has this really famous watch, the Speedmaster. It went to the moon. It's the one that the astronauts wore and everything like that. My dad's favorite watch, so I've always been a fan of it and have followed it. But basically, Swatch released this version of it where it's like a plastic swatch. It's a quartz watch, and you could buy it for I think $270. So this is a watch that typically it's an Omega, it's an Omega intellectual property, I guess, the design and everything. You could only get it for like $6,000 or more if you're buying the real Moonwatch one, and now you can get it for $270. So people are lining up out in front of these Swatch stores as soon as they release it, because they only released it in certain Swatch stores around the world. There was like a limited number of like 40, I think, in the world. And there were people lining up, thousands of people, like maybe not thousands, like up to 1,000 people lining up outside of these stores at night and mobbing the door when they open it up. And they only had like 50 of them to sell because they didn't anticipate the demand. And it's kind of been like that ever since. They've sold out as soon as they get any stock in. So I wanted one, but there weren't any Swatch stores nearby that sold them. So when my wife and I went to Florida, there was one that did, and we happened to be there on a day that they were stocking them, and people were starting to line up outside of the store. And so I told Ethan that we were going to go there, and asked him if he wanted one, and he did. So I got in line, and I also bought one. And luckily, they had two of the ones that we were looking to get when I got up to the front, because they have ones themed after the different planets. You can get Mars. Like I got the Mars one. They're fun colors.
That's cool.
And yeah, it created this exclusivity on the secondary market. It's a $270 watch, and they're selling for $1,000 on the secondary market.
That's phenomenal. I
They've
love it.
cooled down since then. There's only one that's still kind of above that $1,000 mark, but Ethan's got the
Yeah,
Pluto.
Nick picked me up the Pluto one.
Nice.
It's I like that one.
He wait he waited in line and everything, and I was just the beneficiary.
It's so
I
that's
was gonna do
great.
that anyway.
But they only gave
Yeah.
you two, right? They would only allow you to buy two. Is that right? Yep.
You could only buy two per person. I was there with my wife. I could have bought four, but I wasn't gonna keep other people from getting them because a lot of the people there were like me. They actually wanted it for the thing or whatever. They're not going to turn around and flip it. So I wanted to make sure they had it. But there were people there with their whole family and they were counting their kids and they were getting like eight.
That's the only reason they had kids, Nick. They're just preparing for this day.
Just
They'd
for
get
the
eight watches
Swatch, the
just for the
Swatch release.
swatches. Oh my
Yeah.
gosh. Well, and I know I got us off track there a little bit. I think you have a couple more slides, but at the end of the day, this is something we've talked about several times in the last few months. But as investment managers, to me, thinking about the concept of illiquidity, and the illiquidity premium. I always talk about David Swenson. Unfortunately, he passed away a couple years ago. Yale's kind of just managed their endowment for a couple decades and had such better performance than the other endowments. And if you read his entire book, I mean, it's a really thick book, Pioneering Portfolio Management. But if you had to condense it down into a couple sentences, he would say, "Why in the world are these other endowment managers not giving up liquidity with any percentage of the assets? They're not spending all of this money in one year." Right? So essentially, there's these little gold nuggets, and if you're looking for them, you make this what could be considered a trade-off for one person. You're giving this trade-off of, okay, I have less liquidity with this asset class than others, but do you need that liquidity? And if the answer is no, I can sacrifice liquidity here, then you get that illiquidity premium and you get positive alpha, right? You get this return stream that's very, very solid, low volatility range compared to, let's say, equities in general, public equities like the S&P 500. You give up some liquidity, which you don't need anyway. So your trade-off, it's almost like a moot trade-off, right? You make this what could be a trade-off to one and having less liquidity. But if it doesn't hurt the person that's making the investment, if they don't need that liquidity, why not take advantage of that opportunity? And that's really Swenson's message over and over again is, hey, we beat all the other endowments from a performance perspective because we didn't need liquidity with 100% of the $50 billion that's in the Yale endowment fund. So we'll give up liquidity with a good percentage of those assets, and it showed very obvious in the returns, and that's in his mind the major contributor. And it's very feasible for advisors, in my opinion, to blend that concept into their clients' portfolios. And this is a great example of it. Love it, man.
Yeah. Yeah.
I
Great.
had, I had
Great
a
stuff.
professor. Oh, sorry. Go ahead, Nick.
No, no, no. You go on ahead.
I was just going to say I had a professor that worked for a large family office that he talked a ton about that. The family office itself was was making non-traditional investments. They were different types of cars, boats, planes, that kind of stuff, and also they were apparently the largest. They owned the largest Christmas tree farm or a series of Christmas tree farms in the world. So they owned a bunch of Christmas tree farms, and that was part of their illiquid asset allocation, and they did very well with it.
Yeah, very, very neat stuff. Very neat stuff.
Yeah, good stuff.
So
Yeah.
where did we cut? We interrupted you, Nick, right in the middle of all this with about a 20-minute little diversion there. But
No, that was great. I was just trying to remind myself of that. I think the big takeaway from this chart is we've got some pretty solid returns that are somewhere between stocks and bonds, and we've got uh, zero correlation close to it. We can't really get the full figures because we weren't able to export this CSV data. But if you just look at this graph for the higher end of the watch market, so the overall index, which is overweight with the luxury brands, and Rolex, which behaves more like a true luxury brand where you can't buy one. Not very correlated with the overall market here. Other brands, we see a little bit more correlation there. So that's just an interesting little tidbit. But I think the big takeaway here is with the right management, the right choices here, you can reduce correlation and get pretty solid returns, which is great for incorporating it into a portfolio for a number of reasons.
Absolutely.
Here we've got a 5-year look back. Again, this is only three brands. We've got Rolex, Omega, and Casio, I think. Yeah, let me just make sure my computer was blocking it there. But yeah, we see again, Omega kind of kicks around similar-ish to the market. I know this graph is kind of messy, but you can kind of get an idea of the way that it's moving, and you see it's got a similar-ish pattern. There's definitely some correlation there. Whereas with the Rolex market, it's definitely got less correlation there, and a great return too. Definitely not stock. The S&P is up 86% over this period, total return. Rolex is up 41.5%, which is great also, especially for something that's not super correlated and gets you that different return. I think, Ethan, would you like to add anything on this 5-year one, or should we?
No, I think that's the big story. That's even after the collapse of prices
Yeah,
after the big excitement during COVID. But just the lack of correlation with very strong returns, and it certainly is an attractive potential for somebody who's able to lock up some liquidity.
yeah, 100%. Speaking of liquidity, we've got some expensive watches here. I went on ahead and pulled some data for that. These are like the big three brands for watch collectors, I guess. If you're really into the high end stuff, these are the high end brands. We've got Patek Philippe, Audemars Piguet, I think. I can't pronounce that properly, but something along those lines. And then Vacheron Constantin. And you can see if you step into these even more expensive, even more exclusive brands, you get even crazier returns. This is 3 years, I believe. Yeah, 3-year time frame. Rolex up 17. We've got these big three brands up over 50%. And I jokingly threw in a unicorn here because the joke is if you're trying to buy one of these new, you have a better chance of seeing a unicorn than buying one new because you have to be on a list. You have to be on a list, and you basically have to have bought one at retail before in order to get one. So your chances of getting a new one are quite slim. But this is the action pre-owned. This is the price action pre-owned. So this is not movement based on someone buying it and then flipping it. This is purely speculative moves just on pre-owned watches. Again, following that same pattern, it's an index managed by the person who curates watchcharts.com, a representative grouping of 30 models from that brand. And that's the performance from those.
Gotcha. Wow, that's impressive.
So even more illiquidity premium there.
Yeah. Scarcity, illiquidity, all of
Yeah.
it combined, right?
Yeah.
I love it. You must live you living in Virginia, man. You don't see many unicorns. You need to move out to Ohio. I see unicorns out here all the
Yeah.
time, man. You got to really
Yeah, I
That's
didn't
one of the
see any.
advantages. I wouldn't put up with all this snow and cold weather if I didn't get to see unicorns on the regular. So
Man, I missed out.
yeah, that's all awesome, man. That's really interesting stuff. Very enjoyable conversation for nerds like me, nerds like myself that like this stuff. So, what else, Nick? You got any other
I've got a
slides or
couple other
interesting data?
we can touch on it really quick because I know we've gone long here, but we've already talked about the scarcity part of this. We've talked about Rolex. You can't buy one. It's just like those other high end brands. You can't buy one. Creates this crazy aftermarket, price action, all that, and then discontinued watches, especially like Omega brands like that. The discontinued watches, you start to see that type of action with them, especially if you're picking the right one. Like a great example. I don't think it's discontinued right now, but with Omega, you've got the Snoopy, which is like this really exclusive Speedmaster. That starts to get into similar action. So if you know what you're looking for, you can find those types of that type of movement even within less luxury brands. But I thought we'd close out just with some interesting stuff on corporate structure, just because I thought it was interesting. Just if you look at the way Rolex is constructed as a company, it's really interesting. The person who founded it, he was a German kid. He was orphaned at the age of 12, I think, and moved to Switzerland. He got involved in the industry, and throughout his life, he progressed into owning his own watch brand that became Rolex. Uh, as he got older, he didn't have an heir to pass the company on to. And so when he died, he basically put it in a trust. It became a foundation. And so basically, no one owns Rolex. No one at the top, I think. It's really weird the way that it's constructed. But from what I understand, the people at the top aren't really benefiting from the profit that they make. It's managed by some, um, trustee managers, and they or trust managers, and they just do what's best for the brand, and they don't really receive compensation for it outside of maybe getting a watch every now and then. Which maybe not small compensation if you look at the chart that we've just looked at. Um, but that's the crazy part is and the other thing too is in Switzerland, it's not the same as in the United States. It's not like a lot of people say it's a non-profit company. It's not really a non-profit company. It's a foundation that no one owns. So in Switzerland, with their tax laws and everything, they don't pay tax on profits. And so, it's a private company. Nobody knows much beyond that. People speculate that they have enormous amounts of cash hoarded away. But just an interesting little side note there, just on corporate structure, if you're interested in that sort of
That
thing.
really is. Before now, I learned of this today, right? I mean, obviously knew of Rolex, but if you would have asked me, I would have guessed something like, I they trade on a major exchange in whatever country they're and finding out that information from you today, that it is really, it's pretty cool. I never had any clue that Rolex was structured that way.
Yeah,
It,
crazy.
it's interesting because that kind of feeds into some of the exclusivities of a brand like Rolex and the scarcity. They don't have to make watches if they don't want to. They focus on their craft. They focus on making beautiful art in their what they would consider to be art, and they set the price and they sell it for the price that they think it should be sold for. And they don't, like your dealers, they're not allowed to sell above MSRP, right? The secondary market is what prices the watches, but Rolex just, they focus on quality of watch, and like their craft more than anything else. And that's another thing with watches as we go forward. It's really becoming a lost art in some degrees, which is somewhat the perp that is creating the appreciation, because as people go to smartwatches, Apple watches, and what all the these kind of consumer electronics, people that appreciate it really appreciate the scarcity of a really finely tuned, finely built, handmade watch. And Rolex is not a company that's just making more because they'll make more money, because they could certainly sell more. They'd sell whatever they've produced. I mean, they're gone
Yeah.
as soon as they hit the retailer, they're gone. I mean, they've got a list of that. Nick and I went into a shop here in Ohio when he was in Ohio, looked and just asked them about their list. They got a list a mile long for every model. And they just, whenever they get one in, they just call the list. And if the first person doesn't want it, the second person will. And they got 100 people on that list. They could sell, you know, hundreds of times probably the number of watches that they sell, but they don't, because they don't need to, and they're not profit centric. So it's kind of an interesting part of why some of the scarcity is there in a market like this.
Yeah, absolutely. Super, super interesting stuff, fellas. This has been very enjoyable for me, and hopefully for the audience. But I know we went a little longer, but it's really easy these days. If somebody doesn't want to listen to us talk for 45 minutes, and they can stop at 20 minutes, right? But hey, is what it is. And I thought this was great. So thanks, fellas. Really, really great stuff.
Thanks, Landon.
Thanks,
All
Tom.
right. If you don't have any parting words, let me know. Otherwise, we will wrap her up. All right. Very
Nothing from
good.
me.
All right. Thanks, Nick. Thanks, Ethan. And we'll talk to you soon. Bye bye.